The Venetian Las Vegas is not collapsing in plain sight. It is being quietly restructured from within. Why is this happening? What is being hidden behind marble floors and painted ceilings? And, more importantly, who is really benefiting from this transformation? Because while the facade still sells luxury, another system is emerging underneath. One built on cost extraction, automation, and fixed financial pressure. And here is the more dangerous problem. Guests are still paying premium prices for an experience that is no longer being fully delivered. This is no longer a warning. The shift has already begun. If you value clear, data-driven investigations into Las Vegas, consider liking this video, subscribing, and turning on notifications. The Venetian Las Vegas officially opened on May 3, 1999, with a total development cost of approximately $1.5 billion, one of the largest private construction projects in U.S. history at the time. It was developed by Las Vegas Sands under the leadership of Sheldon Adelson, who envisioned something fundamentally different from the existing strip model. This was not designed to compete on spectacle alone. Adelson's strategy was to reposition Las Vegas as a destination capable of delivering global-level luxury. The Venetian introduced an all-suite concept as its baseline offering, with standard rooms averaging over 650 square feet, significantly larger than most competitors at the time. It integrated a high-end retail mall, a convention center, and curated dining experiences that attracted international attention. Throughout the early 2000s and into the 2010s, the Venetian consistently operated as a benchmark property. Competitors measured themselves against it when signaling seriousness in the luxury segment. Its convention business, in particular, generated stable, high-margin traffic that insulated it from volatility in casual tourism. But that positioning depended on a specific operational philosophy: high staffing levels, attention to detail, and long-term investment in the physical product. That model defined the Venetian for over 2 decades, and it is precisely that model that is now under structural pressure. In March 2021, Las Vegas Sands announced the sale of the Venetian Resort for $6.25 billion. The transaction fundamentally changed how the property operates. The buyer structure was split. Vici Properties acquired the land and physical real estate for approximately $4 billion. Apollo Global Management acquired the operating business for roughly $2.25 billion and assumed control of day-to-day operations. This is a classic sale-leaseback structure. Apollo does not own the real estate it operates. Instead, it leases the property from Vici under a long-term triple net lease. That means Apollo is responsible not only for rent, but also for property taxes, insurance, and maintenance. The lease includes fixed annual rent payments with escalators tied to CPI and contractual step-ups. This creates a non-flexible cost base. Regardless of revenue performance, rent obligations must be paid. On top of that, the acquisition itself was financed with significant leverage. Debt servicing becomes another fixed pressure layered on top of rent. The result is a structure where cash flow must be consistently extracted to meet obligations. And when revenue fluctuates, the system does not adjust downward. It pushes pressure inward into operations. The broader operating environment has already begun to reflect that pressure. According to data from the Las Vegas Convention and Visitors Authority, total visitor volume declined by 7.3% in the first half of 2025 compared to the same period in 2024. The contraction accelerated during the summer. June 2025 recorded an 11.3% drop in visitors, followed by a further 12% decline in July. At the same time, hotel occupancy across the Strip fell by approximately 15% in June 2025. But pricing moved in the opposite direction. Average daily room rates increased beyond $163, even as demand weakened. Premium properties like the Venetian continued to price significantly above that average, often exceeding $300 to $500 per night for standard suites. This creates a divergence. Fewer visitors, lower occupancy, higher pricing. Gaming revenue across the Strip declined by nearly 5% in early 2025. International traffic, particularly from Canada, showed sharp reductions, with some airline routes reporting passenger declines exceeding 60%. So while top-line pricing remains elevated, underlying demand indicators are weakening, and that imbalance is where financial pressure begins to build. This is where the financial structure begins to translate into operational reality. The Venetian is now operating under layered fixed obligations. First, the lease payments to Vici properties, which include annual rent escalations tied partly to inflation and contractual step increases. Second, the debt servicing tied to the $2.25 billion acquisition by Apollo Global Management. These are not discretionary costs. They do not adjust when occupancy declines or when gaming revenue softens. At the same time, capital expenditure requirements remain. A property of this scale demands continuous reinvestment: rooms, HVAC systems, public spaces. But under pressure, CapEx is often deferred. Maintenance cycles are extended. The physical asset begins to age unevenly. Operating leverage amplifies the problem. When revenue declines even slightly, margins compress faster because fixed costs remain constant. Labor becomes the primary variable, and that is where reductions begin. Layoffs below the 50-employee warn threshold, repeated in controlled waves through 2024 and 2025, indicate a deliberate strategy to reduce payroll without triggering regulatory visibility. This is not theoretical pressure. It is already happening. The system is actively adjusting to sustain itself. The pressure on the Venetian is not isolated. It reflects a broader shift across the Las Vegas market. Data from the Las Vegas Convention and Visitors Authority shows a clear divergence between Strip performance and local markets. While the Strip depends heavily on tourism and high-spending visitors, local casinos, serving residents, have shown relatively more stability during the same period. Airport traffic at Harry Reid International Airport also reflects volatility. Passenger volumes in mid-2025 declined in line with reduced visitor numbers, particularly from international segments. This matters because properties like the Venetian rely disproportionately on convention traffic and long-haul travelers. At the same time, competition is expanding beyond Las Vegas. Online gambling continues to grow across multiple U.S. states, capturing a portion of gaming demand that previously required physical travel. Macro conditions add another layer. Higher interest rates increase the cost of capital. Inflation reduces discretionary spending. Travel becomes more selective. So the market is shifting. Demand is fragmenting. And Las Vegas is no longer the only destination competing for that spend. Here is the contradiction at the center of the Venetian. On the surface, pricing signals strength. Room rates remain elevated. The property still presents itself as a premium destination. Revenue, at least in nominal terms, appears stable. But underneath, the indicators tell a different story. Visitor volume is declining. Occupancy is softening. Service depth is being reduced. Automation is replacing human interaction. So you have a system where the external signal suggests luxury, while the internal structure is being compressed. That gap is the risk, because the Venetian is still charging for an experience built on attention, recognition, and service consistency. but the operational model is gradually moving away from those exact elements, and that creates a delayed effect. The numbers may hold in the short term, but the perception of value begins to shift, and once that perception changes, the adjustment is not gradual, it is abrupt. So the question is not whether the Venetian will collapse. It won't. Not in the way people expect. The building will remain. The lights will stay on. The marble will continue to reflect the same image it always has. The real question is structural. Can a property built on human-centered luxury continue to justify premium pricing, while systematically reducing the human layer that created that value? Because the pressures are not temporary. Fixed lease obligations, rising cost of capital, softening demand, shifting customer behavior. These are not short-term disruptions, they are long-term constraints. And the current response, higher prices, reduced labor, increased automation, solves the problem on paper, but not necessarily in reality. This is the test that has already begun, not just for the Venetian, but for the Las Vegas Strip as a whole. A system built on experience, now being optimized like a balance sheet, and eventually, those two directions either align or they break. If you found this analysis valuable, consider liking the video, subscribing to the channel, and turning on notifications. You can also explore our related investigations into the structural shifts reshaping Las Vegas today.